Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. As we enter a week of significant releases on inflation data and serious geopolitical brinkmanship, it's time to take a look at what will shepherd investors through the bumps by ETFs. ETFs in Canada have been hitting record highs in recent months across the whole Canadian industry, as well as at Fidelity in particular. Investors are more and more interested in a vehicle that allows for broad diversification, core positioning, as well as the wherewithal to add particular strategies for easily enhancing risk or just as easily decreasing exposure to risk. Joining us here today is Fidelity's Vice President of Product, Andrew Clee. Today's show is in English with live French audio interpretation for anyone who would like to join us in either official language. A warm welcome to you, Andrew. Great to see you. Happy
Thank
Monday.
you for having me.
Delighted to have you here. And everyone who's joining us, please send questions in for Andrew Clee over the next little while. Head of Product, let's get into the discussion of ETFs. Take us through the numbers for the last couple of months. Some of them have been blow the barn doors off, haven't they?
Yeah. So previous record on a calendar year basis was about $76 billion. We did that last year. To put that in context, we're at 65 through the end of July in 2025. So huge gangbuster numbers. July posted close to 10 billion in net sales, and so June had a record month, slightly below that.
June was 7-ish, and that was massive.
For a June record and
now
July record. We're on pace for a year-to-date record, but I think what was really interesting is the shift that we've seen on a calendar year basis. So I've worked in the industry since about 2008, financial crisis, terrible time to join the industry.
Indeed, must have learned a lot.
But it was also the start of U.S. exceptionalism. So I've been following this industry forever. If you kind of went back from 2000, 2008, Canadian equity was the place to be. It was the best performing developed market in the super commodity cycle. Since about 2009, U.S. equity dominated ETF flows. And this year, we actually had a challenger in international equity. So it posted very, very strong numbers at the beginning of the year. The tariff war, the uncertainty around administration policy in the States, money started moving away from the U.S. in favor of Canada and international. We actually saw that flip in July. So July, there was no single international equity ETF in the top 20 for flows.
That's massive, actually, because it's been a massive trend through the first half.
And it's also one of the best performing asset classes in the equity space on a year-to-date basis. So we actually saw money flip back towards the US in July, which I would say is a notable shift when we actually contrast, let's call it the first 6 months of the year and then the 7th month. And that's no surprise. We've also seen US equity markets accelerate on a relative trade to the international over that time.
Do you think, okay, so we'll talk about the US reasons for that in a second. Yeah. Do you think that the international trade has run out of steam or it's just gone too far?
I don't. So if you look at forward earnings, so PE multiples, let's call it international trading 15.5 times, US was trading 22.5 times. But if we rewind to, let's call it April, when I would say things started to slow down, the US got as cheap as about 18.5.
Yeah, that's pretty good.
And so the risk there was to the upside, I think, and we would have been telling a lot of clients that, hey, the multiples have come down a lot, and we saw that reaccelerate very, very quickly. The Mag 7 took off again. We got back to that 22.5 handle. I think it peaked around 22.8, 23 times. But international still is trading 7 points cheaper. So I think the question we have to ask ourselves is, how far can we push that mean reversion on relative valuation? Because the US has always been more expensive than Europe or Asia, just because you pay a premium for high quality companies. And one would argue that there's higher quality companies in the States than the broader market. And so there's obviously single company views that have very strong companies within that region, but on a broad basis, there's always that premium on the US market. And so how tight can that mean reversion trade get, I think, is the question people are asking themselves. So if it can get to 5 times, then maybe you start seeing some flows out of the international space. But I think the geopolitical argument that you touched on earlier was also a driver of repatriation back to domestic markets earlier in the year.
Well, I mean, another big piece of it is what we think is a depreciating US dollar. The question is whether that has legs. I don't know. But for many other reasons, just taking your money out of assets that are in a depreciating currency was one piece of the story. Why don't we just pick up on that? Where do you see for the US dollar? It'll be tied to the Fed, no doubt. But
yeah, so if you try to look through history of what Trump is trying to accomplish, let's call it Industrial Revolution 2.0.
Okay.
So bringing manufacturing back to America. if you actually look at the first industrial revolution, there was 3 key ingredients that led to it. So the first was a weak US dollar that allowed foreign companies and companies to invest in American manufacturing. There was weak energy prices that allowed investment within the US economy for the first industrial revolution. The third one that's not on this administration's agenda is immigration. So a lot of those factories were filled through immigration, through workers that built those manufacturing jobs. But now let's fast forward to what we would say, okay, what's the Industrial Revolution 2.0? American wages won't allow you to fill those factories just on a relative basis to emerging markets and the cost of human capital. So I think the focus here is going to be Industrial Revolution through automation. So you hear a lot about building plants that have highly specialized tech. So the ingredients that the administration would need to bring that manufacturing onshore successfully would be a weak dollar. So I do think there is an agenda to weaken the dollar. Mm-hmm. And you've seen it play out on a year-to-date basis since the administration's taken place on their new agenda. And then weak energy prices. So
not bad.
Yeah, so you're seeing states approve fracking that have previously banned them. So if those 2 ingredients come into a place, I think the question is, what is the cost of automation? And then you see companies like Apple that have announced a $100 billion investment in the States. You've seen Japan announce huge investment in the States. So it kind of brings this whole tariff negotiation is also a negotiation of how much will you invest in American.
To create an innovative factory in the US to sell your own things.
Yeah. So I do think, even if you hear David Wolf, David Talk, or any of our asset allocation team, there is concern around the US dollar strength. And I think it also is part of the agenda in order to bring that manufacturing onshore, because you do need that to promote foreign investment in the US economy.
Let's talk a little bit about the tariff revenues, where it's being used in the US, to what extent it will do what it's trying to do on sort of the fiscal side of things, get debt down ultimately. Yeah. Is it working?
I think it's too early to tell.
Right.
Because they're running a fairly large deficit, or plan to run a fairly large deficit. So I'd say paying down the debt is too early in their agenda to see how that plays off. That being said, tariffs are technically a tax. So the question is, who's going to pay it? Are the companies going to pay it out of margins, decrease profitability? Stock market wouldn't really like that. Is the consumer going to pay? That's going to reinvest itself in inflation. The consumer is ultimately going to be paying the pass down from the companies doing it. So tomorrow is going to be a pretty important day.
There's a CPI report tomorrow, so we're recording this on a day before we have that signal. Yeah. But even without it, there are inflationary pressures.
There is, yeah. And the reality is tariffs have a larger impact on goods than they do services.
Okay.
So when you actually look at the component of inflation, you call it sticky inflation, core inflation, non-sticky inflation. There's a lot of names, but the way that I kind of view the world is sticky inflation is the type of inflation that we can never get back. And so wage growth would be an example of sticky inflation. It's very hard to cut someone's wage. In Canada, it's next to impossible. It's slightly easier given employment law in the States. Whereas goods, you saw all the companies, so Apple fills 3 planes full of iPhones, beat tariffs. Hermes loads up a bunch of planes with the Birkin handbags, flyers them over to the US. Ford takes a bunch of engines from Ontario.
The copper story too.
Exactly. So everyone rushed to build inventory ahead of tariffs. And what you need to remember there is that's working capital on behalf of the company. So it's actually not efficient to sit on inventory unless you can sell through inventory. And so the counter argument would be, okay, if I sit on a bunch of goods and the consumer gets weak, what is the company's reaction going to be to free up their working capital of inventory is put things on sale. And so that's the counter argument. So I think tomorrow CPI, the estimate is, if you look at core, so ex food and energy, they're looking for a 3.0% year over year for the July. If you get into the low to mid 3s, I think that's going to send some alarm bells off.
Right. So
the target is 2 to 3%. Right. If it comes in sub 3, they're going to say there's no inflation,
right,
and they're going to declare victory. So I think tomorrow is going to be a fairly important day to take a look at that inflation number.
So it will, and it's going to play into what the Fed is thinking about. Some thoughts on the changing nature of the Fed, because we know at this point the discussion has been for a post-Powell Fed. He's in charge for some time. They seem to have signaled that they won't let him go early. All that said, there are some new players on the chessboard at this point. What do you think of some of these new players?
Yeah, so Powell's term expires in May 2026, but he has the option. So he's technically on the board for, I think, 2028.
To vote.
Yeah. So he can remain governor should he tend to decide to extend his term. But we had Adriana Kugler, who stepped down early. So she was supposed to come down in Jan of 26. She resigned early, and Stephen Moran came in. So he was just appointed about 4 days ago by the administration. I think what's notable about him is in 2024, he was a member of a fellowship at the Manhattan Institute, so a think tank that writes on economic. He wrote a paper on a tariff-centric approach to reducing the deficit.
Right.
So right off the bat, he's supportive.
This is 4 years ago, you said?
2024, he wrote it.
2024, okay.
Yeah, so right off the bat, he is supportive of the tariff agenda. He's also publicly called to reduce interest rates and say the president has a very strong track record of it. So we now have a voting member, or soon-to-be voting member, that we know is going to come in dovish, or expect to come in dovish based on previous comments. I think the big question is whether Senate can approve him ahead of the September deadline.
So what are the dates? So they all come back in September.
So I think the Senate's coming back September 23rd. That's they're going to reconvene. The next Fed vote is on September 17th.
So it sounds like no, he won't be there for that.
Unless they call something early, and I'm not going to speculate on that.
Okay.
But the market today is pricing in an 85% chance of a September cut for the Fed. So
even before he was appointed, there was a very high likelihood.
That's right. And I think this is also going to introduce some uncertainty, because if you actually look at where he came from, so he came from the Council of Economic Advisory for the administration, so he's currently sitting in the White House as an advisor to Trump. But the way that Yellen and Bernanke actually entered the federal government is from the same council.
Interesting.
So from the
there's
Federal
precedence.
Reserve. Yeah.
Precedent there.
So you have to be a sitting member to be elected chair. We had Bernanke and Yellen come out of that council. They were appointed to the Fed, and they were ultimately the Fed chair after that appointment. But I do think it's going to create some friction, because the market may speculate that he's the upcoming chair. And so you could have a shadow effect, so a shadow chair, where the market listens to his commentary more so than Fed Chair Powell. So you're going to have competing views in public speaking. And so which one is the market going to listen to? I think that's the uncertainty that we don't know how it's going to play out, just given the recentness of this appointment.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connect's, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
I mean, do you think that we were talking about shadow feds and the possibility of it really since the inauguration, maybe before that, I can't remember, but it's been for months now. Are you concerned about this? You are someone who watches the macro picture as carefully as you watch much more micro things. What is the significance?
I think it could create volatility.
Okay.
Yeah, because if you have very dissenting views between the current chair and what may be the future chair, I don't know which way the market will listen. And I think that's what we have to watch play out in the coming months.
I mean, it seems logical that if they know that someone else is coming in,
that they would lean to
that
the
they
shadow.
would lean to that.
Yeah.
But I mean, again,
and this came faster than we expected. We weren't expecting this turmoil until January, when that was the day that Adriana was actually supposed to end her term. So it kind of fast forwarded, let's call it, by 6 months. And that gap between the May end of term for Powell versus the new appointment that was supposed to happen in January of 26, that left a relatively short time window for whether Powell would extend or if we would have a new chair in May. And so it'll be really interesting to see with this much time between the end of his term versus what we would expect it to be 3 or 4 months, now looking more like 10 months.
I mean, I guess the other thing that you have to ask is, what does it mean to have interest rates coming lower too soon when inflation is, I mean, it's a stagflationary environment. What does that do to the dollar? Yeah. Does the lower interest rate allowing a little bit of inflation, let's just guess this is a scenario, allow for that US dollar to go lower? Is that the path?
It does, but the thing is that the Fed has a dual mandate, which is employment as well as inflation. The Bank of Canada only has an inflation mandate. So the U.S. economy is actually fairly strong. Like the 3% GDP print we just saw would suggest that they don't need to lower interest rates because, hey, that's kind of the long run average that we've been seeing out of developed economies. And one would suggest that, hey, at 3% economic growth, you probably have an appropriate interest rate policy. The bogey will be inflation. Should they lower rates, that's actually inflationary as well. So are they going to pour fuel on the fire? I think we have to see the inflation print tomorrow and make a call.
Okay, so there's that. Tell us how an approach to what is offered in terms of fidelity products that are ETFs can help sort of get you through here. There's been some interesting themes within the inflows, within those actually massive numbers that you pointed out. What are some of them? What do investors want to make sure they have exposure to or not?
Yeah, I think it's appropriate to be diversified. And the reason I say this is we have a Fidelity portfolio consulting team called Fidelity Portfolio Solutions. They've met with hundreds of advisors, and what we see is a massive overweight to U.S. growth.
And is Rush back in there?
No, I'm just saying that I think over the last 10 years, it's done so well that it's grown disproportionately relative to international or Canadian equity within advisor books. And so I think the U.S. economy is something that you do need to own. But I think also just the run it's had relative to the rest of the world would have taken it from a 25% weight to a 35% weight. And also value really only worked in 2022 and somewhat to a degree in 2023.
Okay.
So we're seeing a big bias towards U.S. growth and not style diversification across investment style or geography. So I do believe that buying global equity is probably the best place right now because it allows the PM to make the call on relative valuation or geopolitics or macro on U.S. relative to international, and you don't necessarily have to make that call yourself. And the reason I say that is when you meet with a number of our PMs, the argument will be the US tech sector is the best in the world. There is no NVIDIA in Europe. There is no Facebook in Europe or Meta.
But what about China?
They do exist there. So you have Alibaba, you have Tencent. But at the same time, buying a grocer in Europe versus buying the US, you can actually have very similar company characteristics and pick up the European grocer at a much cheaper valuation. But I may pick up my defensives or my utilities exposure through an international play. So I think the global equity space is probably what we have an opportunity right now in the advice community to say, I don't want to bail on US, but I do want to pick up the relative valuation argument in the international. You can leave that to portfolio manager to find those unhidden gems.
So it's interesting. What do you suggest for a counterweight for something that is less correlated? Used to be bonds, but is it still?
No, it's really interesting. Urian has a big piece about the new 60/40.
Yes, he does.
And he added close to 20% alternatives in it. You've seen our asset allocation team, FMPs, add liquid alternatives to the lineup. The PIPs have the Fidelity Brookfield Fund. That's private real estate. I think there is a growing argument that you need to be looking to alternatives within the 60/40.
To make sure that you have something.
And I will say that if inflation rebears its head, bonds won't offer that same correlation that we expect. I did do a lot of work on this following the 60/40 2022 meltdown, I should say.
Where everything went down together.
I don't know what the argument is. So inflation is part of the reason that it came back, but also there could be a number of things. So duration's been massively extended because of offerings and zero rates. It's business to 101. When interest rates are low, issue debt as long as you can. You may not have those 100-year bonds when interest rates are at 4%, 5%. They did come out when interest rates were at zero.
And it was a long period of time that interest rates were basically zero. I mean,
arguably
it was a very
too long.
long time. Yeah, arguably too long.
But I do like the idea of liquid alternatives. And so take, for example, someone like Dave Way, Fidelity Long Short Alternative. When you have this type of volatility in market, a long-only PM has to make a decision. Is this stock cheap enough that I want to buy it today, or is it going to get cheaper? When you run a long short book, you actually have the option to say, I like the stock at this price. I may not have the full conviction, and you can enter what's called a pair trade. So you buy the long stock and you actually hedge it with two similar stocks that are short. And then when you get further clarity around the tariff environment, the geopolitical environment, the company outlook, whatever that may be, whatever the thesis is, you can start taking off that pair. So it allows earlier entry into stocks that you like with a hedge opportunity, and then you can remove that hedge as clarity increases. Commodities have played an important role in 2025. Golds have been fantastic. Bitcoin's been fantastic.
Not all commodities, though. A lot of them. I mean, the energy story has been a bit wonky. The actual spot price.
And gold got really wonky last week when there was talks about tariffs on Swiss gold.
Yes.
So if you actually looked at the December futures contract last week, it traded at $100 premium to the spot gold price. And so that's when you really quickly realize the impact of uncertainty and tariffs can have on the price of an asset. And then the administration quickly went to clarify that, and we're back to normal now. But yeah, I think there's an argument for commodities, certain commodities, liquid alternatives and privates as we go forward.
And crypto.
Yes.
You are the person who we always ask about crypto. I mean, from years ago, Ethereum, everything, the landscape for crypto has been far more defined in the United States. We've seen a great amount of interest recently. Where does it belong right now?
So we take an interesting approach. So it is in our all-in-one ETFs and mutual funds. We took a risk-based approach because the reason for that is it's an incredibly volatile asset. The volatility has been decreasing over time. So one thing I would say about asset classes in general is as they become more mature and larger market cap, the volatility tends to decline. And that's just widespread adoption, use in more cases across portfolios. So the way that we integrated it was how much exposure can you take to Bitcoin without changing the risk profile of that investor? And so what the objective would be, there was actually a survey done by the OSC in 2019 that showed how many Canadians owned. I think at the time it was close to 15% of Canadians owned Bitcoin. And then if you actually looked at it, 30 to 50% expected to own it in the future.
And how did they own it at that time?
In
they owned
the
it
physical
themselves.
spot,
Okay.
So on exchanges, cold wallets. But it also has a diversifying benefit. So if you kind of look at the correlation over the last 3 years, it's about 20 to 25% correlated to equities, depending on which market you're looking at. NASDAQ being the highest correlation, S&P currently sitting around 20%, the TSX sitting around 20% over the 3-year term.
This is the pro-risk piece of it.
Yeah, or the diversifying benefit.
Okay.
So statistically significant correlation will be greater than 70%. So that means they move in tandem. When one goes up, they move up together. It also has a zero correlation to the bonds. And so we do see short periods where it becomes highly correlated to risk assets. We see periods where it's not correlated at all. And so when you take into account that diversification benefit, how much can we put into a portfolio without turning a balanced investor into a growth investor?
Right.
And for the 60-40, that landed at around 2%. For a growth investor, that's like an 80-20 stocks to bonds. That number was closer to 3%. And so what we've been able to achieve since we've included it within our all-in-one portfolios is we actually run a nearly identical volatility profile to our peers that don't own Bitcoin. And so that's the diversification benefit.
That's really interesting.
But it has been a significant contributor to returns because you've seen the price appreciation. And just over the weekend, we went from, let's call it 113, 114 back up to 120K today. And that's because the Trump administration has asked to look at including crypto and 401ks alongside private equity and other alternatives. Right. So I think what you're seeing is a push to include alternatives within the traditional 60-40.
Which you're already doing.
Yes.
This has already been available for some time at this stage. And the allocation there is roughly 5%?
In the alts program?
Yeah.
Yes, that's right.
Okay.
Yeah.
That's really interesting. What do you notice about the flows story for the crypto story, for the products that you offer?
Yeah.
What is the flow story there?
So July was the highest month in 2 years in ETF flows.
For ETF, but with the crypto ETFs?
Yep, that's right. Okay. So July posted about 225 million in industry flows in Canada. The number would have been magnitudes of that in the States.
Wow.
But there was a significant renewal of interest in investing in crypto ETFs, both north and south of the border, to the tune of flows we haven't seen on a monthly basis in 2 years. It's also correlated with the price appreciation. So it's quite interesting to see. You also have the administration making announcements like 401ks. If you were to open 401ks to crypto ETFs, that's a significant wave of capital.
Is that an if or a when?
I think that they're pushing this agenda, and the administration, I can't really give a call for certainty, but I think this is a pro-crypto administration that is looking to make incorporations. You would have also seen Harvard Endowment made an investment in a crypto, a Bitcoin ETF specifically. So we are seeing what we would call traditional pension style, endowment style investments start to incorporate this asset class. And it's tough to know. It is over longer term been a diversifying asset. We've obviously seen the price appreciation, but the world of traditional finance modeling. So if you were to actually run an efficient frontier and leave it unconstrained and look at the history of Bitcoin, it would say short every other asset class in the world and put in the entirety with leverage into Bitcoin.
Seriously?
Yeah. From a risk adjusted return. Obviously, that's not reality.
No.
You have constraints. You have maximum allowance on leverage. You have concentration reasons why you would never do it, but that's what the analysis would have suggested if you were to leave it unconstrained.
Okay, so we've talked about sort of the macro story, massive inflows for the ETF story, and all the different products that are offered here. And then what do you want investors to know right now? They're investing through some fog. Some of it is lifted.
Yeah.
There's probably still more to go. What's sort of your message for investors at this point, probably within the ETF story?
Yeah, I think there's a lot of currency neutral options that are underutilized in the Canadian market. So it's very difficult to hedge directly in client accounts. So we've had a number of clients that may have picked their own stocks on US equity that have actually sold down positions of those individual securities and buy our currency neutral ETFs.
Mm-hmm.
I think this is also an important because as a Canadian investor historically, you've wanted to leave your US dollar unhedged because in times of turmoil, the US dollar is a safe haven asset. So it's always provide a shock absorption in down markets for Canadian investors. Being a portfolio manager in the US with a strong dollar was much harder than being a portfolio manager in Canada because we could take that downside protection. So typically what we would have seen is in a declining market, an unhedged equity sleeve would be better for a Canadian than it would be an American because we would get the price appreciation. So I think that exposure and that argument might have changed to a degree. That being said, the Canadian economy is probably, well, undoubtedly the most exposed to US tariffs relative to Europe or Asian markets, just given our relationship and proximity to the US. So it's going to be difficult to navigate for the central bank. We've always done a very, very good job of weakening our currency in terms of economic trouble in Canada, but we've never had that backdrop where the US is also weakening their currency.
Right.
So I think currency neutral portfolios play a more important role now than they have in the last 15 years. And I think style diversification is going to be really important. And the reason I say that is the US has been a very volatile market this year with ups and downs. It's starting to catch up to the rest of the developed world in terms of total year performance, but the volatility is significantly higher. Momentum is leading the pack on an alpha basis, so it's the best performing investment style year to date. But that's also heavily concentrated in Mag 7. So I do think it's time to start looking to global equity mandates that have the flexibility to underweight, overweight US. Because we talked about it before, I think the US is an economy you need to have exposure to. Making that call to go directly to international versus US, I think it's slightly easier in an active mandate that has a global mandate that can diversify across geography.
Let's have a quick discussion of one particular ETF that's been gangbusters, Global Innovators.
Yeah.
Which is Mark Shell manages this, and it's now an ETF, has been for some time. Just give us a sense of how it's done recently.
Mark's done incredibly well since we launched it. So if you actually look at how he performed into the April lows, he outperformed on the downside, reaccelerated back into the momentum trade. So he's done an exceptional job. And I think that's a perfect example of a manager that can say, I want to be in the US now, or I don't want to. And so if you actually look at the holdings, he would have been declining through April as the US was on its way down and then reaccelerating back into it on the way back up. So that's an example of flexibility that I think we need to afford ourselves in today's environment.
Andrew Clee, it's such a pleasure to speak with you. Thank you for sharing all of your knowledge with us here today, or as much as we could fit into 30 minutes.
Yeah, thank you for having me.
All the best.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.